halfway through the year, and it's been a much later start to the rate-cutting cycle than many investors envisaged. And what's more, the pace of rate cuts is likely to be slower and shallower. But still, the process has now started, and after a difficult couple of years for bond markets, it's an important moment. Although structural challenges, such as high debt and deficits, facing bonds remain, the start of a rate-cutting cycle is supportive from a valuation, sentiment, and flow perspective. This comes at a time when the global economic outlook is gradually improving. The US undoubtedly has led the recovery, but there are now signs of this growth broadening out to other regions like the Eurozone. It means that a soft landing remains our base case, and whilst we are of course watching for recessionary warning signs, so far these have been very few and far between. However, it's inflation that remains in the driving seat, and we expect the disinflationary progress to be continually challenged. With goods prices having normalised, the easy wins on getting inflation back to target are now firmly behind us. Nevertheless, countries are at differing stages of this disinflationary process, and we think there are relative value opportunities to be exploited there. Besides the macro environment, the heavy election cycle, with the US election having the main market-moving potential, and ongoing geopolitical tensions keep us alert to additional risks. All this points to the benefits of an agile and nimble approach to fixed income investing, one like our scenario-based process that takes a multi-dimensional view of the world. As interest rates and cash rates fall, we think the attractiveness of fixed income will only increase as investors look to lock in these attractive levels of yield for longer. In credit more broadly, we prefer investment grade and high-quality securitized debt over high yield, given the tightness of spreads. And across the rating spectrum, we place great emphasis on careful bond selection to find idiosyncratic opportunities to deliver attractive returns. In rates, we're more focused on cross-market and curve strategies until, or if, we see recessionary risks rise, and then the focus would switch to a more directional strategy. So for the second half of the year, we aim to continue to exploit opportunities from evolving and at times contradictory market forces using our dynamic approach to assessing the market environment. Considering bond valuations, we're confident our in-depth research-focused approach to credit selection will be more important than ever in generating income and attractive returns, whilst also managing risks.